Hi traders, welcome to Quantsapp and welcome back to yet another video. In this video, we will understand 6 price action trading rules that will make you a better price action trader. So if you are a price action trader, then you should watch this video till the very end. So let's start this video by understanding what is price action. So price action is nothing but a pattern that consensus follow. That means majority of the market follows. Okay, and there are multiple trends or multiple shades of trends in price action. So let's first understand these trends. Okay, what are these trends and how they look like? So there are 6 type of shades, you can call it, of trend. So first one is upward trend, where the price goes up. Downward trend, the price goes down. Pullback, respite, volatile, and oscillating. So we would have all seen how upward trending stock looks like, how downward trending stocks look like, but have you ever wondered, with no indicators indicating a, a halt in price, in an upward trending stock, there comes a big turnaround? Second thing is, have you ever witnessed that, okay, the stock, it corrects from the top and you feel that, okay, now it has made a top, you should go ahead and sell it. But the moment you sell, it gives a up move again. Okay, might be that would have been a pullback. Okay, so now how do you differentiate between a pullback and a short trend? So don't worry about all of these things. In this video we will learn all of that. So let's first understand how upward trend will look like and what are the data points that will validate that, okay, this is an upward trend. So first thing is, we will use futures open interest data to validate this trend. So how we will do it? We will combine price and futures open interest to get to a conclusion that, okay, what the traders are thinking, what the consensus are thinking. So for that, we need to understand one simple thing, that open interest, it involves buyers and sellers both. That means there is no individual buyer or seller who can easily take the open interest, because it is contract. For every buyer there has to be a seller, for every seller there has to be a buyer. Now what happens is, let's say there is a stock 100 at 100 rupees, and at 100 rupees you see that, okay, the open interest is going up. That means there are fresh buyers buying and fresh sellers selling. So you see that, okay, there might be a certain scenario, that's the reason people are buying and selling it. But now what happens is, the stock moves to 110, but on this day as well, you see that the open interest is going up. That means the buyers who are buying it at 110, they are expecting that it might go up even further. That is the reason they are buying it. Let's say you are a trader, if you are buying it at 110, that means you are expecting that it will go up even further, right? Let's say on 120 as well, if you see that the open interest is still going up, that means there are buyers who are buying it even at 120. Does that mean there is no seller? There is seller, but buyers who are buying it at expensive price, they are expecting and further up. So how we can differentiate it? What it is called? It is called as long built up. What will happen to the price? The price will go up. What will happen to the open interest? Okay, so sorry with my drawing. What will happen to the open interest? The open interest will also go up. This is called as long built up. And to validate a long trend, this is typically what you should do. You should simply check if the stock has a lot of long built up. So how you can do it? You can easily navigate to build up. You can navigate to future OIH tool in the application, which will tell us. So what has happened in Bank Nifty? Bank Nifty, see, long price goes up, long price goes up, long price goes up, and it keeps on going up. So if you see that the prices, if they are backed up by long, then it is an upward trend, right? So if you see again, wherever you see that the prices are going up, it is backed up by the additional participation. Over here, Bank Nifty at its all-time high, 42,300 almost, till the OI is going up. That means participants are feeling that, okay, from here as well the rally might continue. Okay, so that is the first thing you should know, that is long built up. So over here, what uptrend will look like is, so let's write down FNO data points, because we will validate price actions with FNO data points. So long, what happens in long? Price and OI go up. Even in the rising prices, the people, they have bought it. How you can easily look at the color codes? Just look at green color. Okay, so over here, if you see, L indicates long, green color indicates long built up, LU indicates long unwinding, red indicates shorts, yellows indicate short covering. Now coming to a downtrend. Okay, what is downtrend? The price will go down. So black color line is showing you price. What is happening to the price? The price is going down, and there are people who are selling it, right? So despite the falling prices, the open interest, it has went up. That means people are selling it despite the prices which are fallen. Okay, so let me just explain you quickly how it will look. So it will look opposite of it. That means someone who sold it, let's say at 120, he is going ahead and selling it even at 100 rupees or 110. Okay, over here as well, if the open interest goes up, that means what? There are fresh sellers who have sold it and fresh buyers who have bought it. So the participants who are selling at 110, they are expecting and further down move, right? So this is called as short built up. What happens in short built up is price, it goes down, and open interest, it goes up. That means despite the stock has corrected to 120, or let's say 200 rupees from 120, still people ready to sell it at 100. Okay, because they are expecting and further down move happening in the stock. This is called as a short build up. So how you can validate, looking at this screen, you can validate looking at red color indicating something negative, right? So red color indicating short. So from here, if you see this short, people sold it vigorously, market collapsed, right? So how you can easily validate a short build up? You can easily validate a downtrend by looking at a short build up. Okay, so let's say short. Now over here, what happens with price? Okay, so price, it goes down, and Y up. So this is the formula. Okay, red color, you can look at simply the red color to identify whether it is a short or not. Pullback, so as I said, markets, they will not go one directional. Okay, it will not be a linear market, it will not go 80 or 90 degrees up consistently. Okay, there will some pullback happening, there will be some dip happening in the market. So now what happens is, in markets, typically if market goes up, then there are profit bookings happening in the market, due to which there comes a dip. Okay, this dip might happen for a couple of days maybe, but there comes a dip, then again the stock moves up. Now how will you figure out that okay, this dip is because of, there is a pullback? Because the price is going down, right? Every price action trader will tell that the price is going down. But how will you differentiate it from a short? So the differentiator factor is over here, the open interest will go down. That means people who have bought it, okay, people who have created a long, people who have bought it, they are now unwinding it. It is called as long unwinding. What happens? Price goes on a dip and open interest also goes on a dip. Now why it is a pullback? Because this dip in price, it is led by what? Open interest getting unwinded. It is not led by active participation, fresh participation. It is called as long unwinding, right? It is called as a pullback. So how we can differentiate a pullback and short built up? So if you see, the blue line is showing us a pullback, it is showing us a dip, right? But this thing is showing us a short. So there happened a dip in the market again moved up. There happened a dip in the market, but the moment this short happened, aggressive sell-off happened in the market, it slipped lower, right? So if I just want to show a bit of historical data for us, so just look at this. Okay, what has happened in Bank Nifty? See, long pullbacks happening, longs pullbacks happening, longs pullbacks happening. One or two shorts will always be there, but that is fine. If you see net, if the data is on the long side and if there are pullbacks happening, these are the dips which should be capitalized on. Now how will you differentiate, a pullback and a short built up? One thing is that pullback is long unwinding. Okay, that means open interest goes down, but price also goes down. Okay, price is going down, but why it is going down? Because the open interest, it has gone down, right? What the color code would be? It would be blue. Respite is again a short covering move. You can easily conclude it by short covering. Okay, what is it? It is a temporary pause or a breathing space the stock gets after consistent falling. So what happens is, let's say someone sold at 120, created a short, right? He has to cover it, and he covers the short, let's say at 110 rupees. There comes an up move, then again it collapses, then again it goes up. Now this is going up because of short covering. How did we know? If the OI goes down, okay, if the OI goes down, that means the existing shorts are getting covered, and due to which the price is going up. So what happens in short covering is, the open interest goes down and the price goes up. So this is called as respite. So how you can differentiate a long and a respite? In long as well, price is going up, but over here the price is going up, but the open interest is going down. That means this up move, it is just a temporary pause. So price goes up and OI down. Okay, so this is called as short covering. So how you can figure it out looking at the chart? You can easily figure it out looking at the yellow color in the chart. right? Now comes volatile market situations, and there comes oscillating market situations. So let's understand first oscillating market. So if you just look at this, okay, what is happening recently? So see what is happening recently over here. You see a lot of longs happening in the market, lot of shorts happening in the market, short coverings, long unwindings, a lot of mixed cues, a lot of participation is happening. That is fine, but if you see it has been relatively low as compared to this, right? So whenever you see that, okay, the markets, they are seeing mixed built up, matlab long bhi ho raha hai, short bhi ho raha hai, there are mixed cues. That means they are not certain about price. There is no clean upward or downward trend. So what is the trend? The trend could be either volatile or oscillating. Now you need to differentiate if it is oscillating or volatile looking at one more analytic. Okay. How can you do it? You can do it by looking at the implied volatility. Okay. Over here you can go to wall grid, search for your desired instrument and look out for implied volatility percentile. Let's keep Bank Nifty for this case. So just focus on implied volatility percentile. So IVP. So now this tells you how many percentile of the times, okay, how many percentile of the times previous IVs of Bank Nifty traded below the current IV, where the current IV is 15.94, IVP is 0.4. That means only 0.4 percentile of times in last 250 days IVs traded below the current level. If it was just 0.4 percentage below the current level, rest times where it was above the current level, right? So implied volatility percentile shows you where you are placed on an implied volatility curve. So if IV percentile is small, you can consider it even that way. If it is near zero, that means very less number of times historically IVs traded above the current level. If it is high, that means many times IVs traded the current IV, it is trading above the current level. अबे ये क्या बोला मैंने? ठीक है चलिए. So you can consider it simply in this way. If IV percentile is around zero, that means the IVs are at the lowest level. If IV percentile is 100, 99, 98, 80, more the IV percentile is, more spiked up the IVs. So now if you see IV percentile is 0.4, that means only 0.4 percentile of time. Historically, IVs traded below the current level, right? That means अगर अभी का लेवल के नीचे से 0.4 percentile of time trade हुआ, rest times where it traded above it, that means the current level automatically becomes around the lowest regime. So it is at the lowest level, that means the uncertainty in the market is low. Second thing that we know is it is a lot of mixed cues or a lot of mixed build-ups happening in Bank Nifty. So you know that indicates us one simple thing: mixed build-ups, okay, mixed build-ups plus low IVP, okay, low IVP. You can consider IVP below 66, okay, below 66, okay, below 66. It will tell you that okay, the markets might not be trending, okay, it might not be a volatile market, it would be kind of oscillating market, right? Similarly, what does volatile market tell you? Volatile market will tell you again mixed build-ups, but in this case you want IV percentile to be high, okay, whenever the IV percentile is high, above let's say 66, above 70 and 80, okay, 70 specifically, that will tell you that okay, people are more uncertain about the future, and even there are mixed cues happening in the market. The market may, the build-ups that are happening, those are very mixed, those are very random, so there might be huge volatility. Those markets could be considered as volatile markets. So yes folks, that was it from my side. If you want, you can take a screenshot of it, and that was it from my side for this particular video. If you want me to discuss on any video, you can let me know in the comment section below. And if you have watched the video till the very end, then do hit the like button, do hit the subscribe button, do hit the bell icon, so whenever we post a video, you will be the first one to receive the notification. Thank you. Bye bye. Take care.